A man paid into the safest sounding financial product in America for 11 years. Premiums, on time, every month. By year 11, he'd put in about $66,000. The amount he could actually touch? $41,000. He was down 25 grand, not on some crypto bet. On the product his financial guy called the responsible choice. That's not a mistake. That's the product working exactly as designed. And there are 4 versions of it. One built for the guy making 30 grand, one for the guy making 300 grand, and 2 in between. By the end of this, I'll give you one sentence, 4 seconds long, that ends every one of these sales pitches on the spot. Watch what it does to the person across the table. Quick and honest, because we're adults. I'm not your advisor. This is education, and insurance is real. Some of it I'd fight you to keep. I'll show you exactly which kind near the end, and I'm not going to pretend it's all a con. What I'm going to show you is where protection quietly turns into profit extraction, and the 4 places the industry crosses that line on men specifically. Not because men are dumb, because the pitch is engineered to skip your math and hit your identity. Let me show you how. Then let's run the numbers they hope you never run. This stuff is sold on identity, and the identity it targets is the provider, the man who's supposed to have it handled. Read the marketing and you'll see it. Be your own bank. Take control. This is what the wealthy actually do. It's built to make you feel like a strategist and a protector in the same breath. Second reason, most of it moves through warm networks. Your gym, your church, the buddy from college who just got into financial services. It's hard to ask a friend cold math questions across a lunch he's paying for. So men sign things at that table they'd never sign on a cold call, because the sale was never about the product. It was about the relationship. And the closer, it's dressed up as secret knowledge. The banks don't want you to know this. Your 401 is the real scam. This is the move. For a guy who feels behind, that framing isn't a sales pitch anymore. It's a red pill. But the moment you make it boring again and run the arithmetic, the whole thing falls apart. So let's start with the big one. Receipt 1, and I'm leading with it because it's the most expensive mistake on this list. The pitch is genuinely clever, sounds responsible, sounds grown up. Here's where it comes apart. A healthy 35-year-old man can get $1 million of 20-year term coverage for somewhere around $40 a month. Go price it. It's a real number. To get that same million through whole life, you're looking at $600, $700, $800 a month, sometimes more. Same death benefit. So where does the extra $600 a month go? The early years, a huge chunk goes to commission. Whole life commissions commonly run 50 to 100% of your entire first year premium. If your first year premium is around $7,000, your agent can pocket $3,000 to $7,000 of it in year 1. That's not a theory. That's the comp structure, which means the person advising you gets paid more the bigger and more permanent the policy is. Hold on to that next time someone tells you term isn't enough. And here's the trapdoor, a surrender charge. Cash out in the first 10 to 15 years and you eat a penalty. And, as we're about to see, mediocre if you stay. After the fees and insurance costs come out, the cash value inside a whole life policy typically grows at something like 1.5% to 3.5% a year. A broad stock index fund has historically averaged around 10% a year over long stretches. Buy the cheap term, protect your family just as well, and invest the difference. Be generous to the policy. Pretend every dollar grew at 3%. You'd land near $350,000. In reality, it's less because the fees eat first. Same money in. A difference of roughly $500,000, and that gap didn't vanish. It went to commissions, fees, and an insurer's margin instead of your retirement. That was the biggest one. Receipt 2 is for the guy who thinks he's too smart to get got, and it's dressed in a suit. This one finds the man who's done well and is scared of the next 2008 or 2022. You get invited to a free dinner. No pressure, nice room, and someone explains a product that sounds physically impossible. You get the market's gains when it rises, you lose nothing when it crashes, and income for life. And every word of that is technically true. And it's built to mislead you. Here's the part that's not on the slide. Indexed annuities have a participation rate and caps, the slice of the market's gain you actually receive. When the market runs 20%, you might get 8%. The company keeps the rest. That gap is your downside protection. You didn't buy protection from losses. You bought a ceiling on your gains and paid for it with the upside. Then the surrender period. Often 10 to 15 years, your money is locked, with penalties up to around 15% if you touch it early. But it gets worse. There's a practice where an agent talks you into dumping your current annuity into a brand new one. Your surrender clock resets to zero. The agent collects a fresh first-year commission. You get penalties and another decade of lockup. And to be precise, because precision is the whole point of this channel, that move isn't perfectly legal. Swapping you into an unsuitable product violates suitability rules regulators enforce. It's just under-policed and devastatingly common. 2 down. The next one is smaller per hit, but you're almost certainly paying it right now this month on autopilot. You're at the dealer. You've been there 3 hours. You want to go home. And the finance manager slides over one last page, covers everything, total peace of mind, just a bit a month. You're tired. It sounds responsible. You sign. Here's what didn't make it into the pitch. These contracts live and die on their exclusions. Missed maintenance, wear and tear, the wrong shop, a late oil change. The denials usually aren't dramatic. They're mundane, and they're in the fine print you didn't read at hour 3. And this isn't fringe. In July 2024, the Federal Trade Commission settled with one of the biggest names in the business, CarShield, for $10 million over deceptive advertising of these plans. $10 million, one company. Here's the system that beats it for most people. Take what you'd spend on the warranty, say $150 a month, and route it to a high-yield savings account that's only for car repairs. In 2 years, that's $3,600. Most people never face a repair bigger than that. If you do, you've got the cash. If you don't, you keep it. The warranty company keeps it either way. That's the only difference that matters. Receipt for paying twice. Let me be straight. This one isn't a scam with a villain, it's a leak. Count the separate insurance payments that left your account last month. For a lot of guys, it's 4 to 8. And here's the quiet part. Several of them are probably covering the same risk twice. A lot of mid-tier and premium credit cards already include things like rental car collision coverage, travel protections, and purchase or extended warranty protection on electronics. Coverage varies card to card and has been trimmed in recent years, so don't take my word for it. Do one thing after this video. Spend 15 minutes reading your card's actual benefits guide. Then stop paying the rental counter, the travel insurance upsell, or the phone warranty kiosk for things you may already own. The frame is one question. Could I cover this loss myself without wrecking my finances? If yes, self-insure and keep the premium. If a loss would genuinely sink you, health, liability, your home, term life when people depend on you, that's not optional, that's the real product and you keep it. Therefore, the goal was never less insurance. It's insurance pointed only at the things that would actually break you. The pattern plus honesty beat. Step back and all 4 run the same play. 1. Make you vividly picture a catastrophe. 2. Present their product as the only responsible thing a good man would do. 3. Collect every month for decades. The tool is fear, and fear makes you stop doing math. Permanent insurance is the right tool in a few real situations. If you're in one, go to a fee-only advisor. Estate's big enough to face estate tax, where a policy gives heirs liquidity so they don't have to sell the business or the farm. A parent of a child with lifelong special needs, funding a trust that has to outlive you. Certain business setups, buy-sell agreements, key person coverage. Or a high earner who has genuinely maxed every other tax-advantaged account and wants one more bucket and understands the trade-offs. Notice what those share. They're narrow, specific, and rare. If you're a regular guy with a mortgage, kids, a 401(k) that isn't maxed, and no estate tax problem, you're in none of those boxes. The product isn't evil. It's just sold to 100 times more people than it fits. So here's the playbook. Steal it. 1. If people depend on your income, get real insurance. Term life, length matched to the need, until the kids are grown and the mortgage is gone. Rule of thumb, roughly 10 to 12 times your income. It costs a fraction of whole life, and your family is just as protected. 2. Capture the full employer 401(k), match first. That's free money, an instant 100% return. Kill high interest debt. Build an emergency fund. Then max the tax-advantaged accounts, 401(ng), Roth IRA, and HSA if you qualify, into low-cost index funds. 3. Self-insure what you can absorb. Repair fund instead of warranty. Read your credit card benefits before you buy a duplicate. And 4. The sentence I promised you. Anytime someone tries to sell you a cash value policy, an annuity, any of it, you ask one thing. Are you a fiduciary? And exactly how are you paid on this? A fiduciary is legally required to act in your interest. If they earn a fat commission the second you sign, they're not neutral, no matter how good the lunch was. Ask it, then watch the energy in the room. That little flinch before they answer, that's your answer. And if you already own one of these and your stomach just dropped, don't panic and don't cancel tomorrow. The early years already hurt. Past the surrender period, the math can change. Take it to a fee-only advisor with nothing to gain either way and have them run keep versus exit on the actual numbers. Decide with math, not shame. Let's land it. 4 receipts, 4 fixes. Whole life by term, invest the difference. Indexed annuities, fee-only fiduciary, no dinner required. Extended warranties, build your own repair fund. Paying twice, read your benefits, cancel the overlap. When someone makes you afraid before they make you an offer, slow down and do the math, not sign. Cheap term for protection. Low-cost index funds for growth. Free money first. Expensive products almost never. That's the whole secret, and it fits in one breath. The 4-question checklist is in the description. Free, download it, use it every time someone slides a folder across a table. Send it to the one guy in your group chat who just got into financial services. He needs it most. Next, I'm taking apart the tax-free retirement pitch, the IUL illustration. Subscribe so you catch it.